Buyback means what?
The company pays the money in the open market and buys the shares, its own shares.
Its own shares. Okay. If the company buy back the shares, whatever the consideration it pays, whatever the company it pays, okay, and whatever the shares it takes back, the transaction will be treated as
Buyback of shares.
buyback of shares. Okay, that buyback will be taxable at the rate of 20%. Whatever the capital gain we get, that will be treated as that will be taxed at 20% plus surcharge of 12%. This is the fixed rates. Surcharge of 12% and education cess and cess will be 4%. Okay, 20% tax. Assume the tax, the capital gain comes to 1 lakh. Assume capital gain comes to 1 lakh. 1 lakh, on that you apply 20%.
20,000.
20,000. For that you add 12%.
So on this 20,000 we will add 12%, or on the 1 lakh
Yes,
rupees
yes.
we will add?
No. On tax. The surcharge will always be on tax.
Okay, on 20,000, 12%. So that will come down to 2,400.
2,400. Add those two. Add those two.
22,400.
Huh.
On that 4% we will calculate cess.
Yes.
23,200.
Okay. $20,000 on that 12%. Add those to 22,400 on that 4%. Total you have to pay if you get 1 lakh rupees of capital gain. Understood? Okay. That is how we need to tax it. On the buyback. Earlier it was only the listed companies were used to taxing at the buyback. Now they made the amendment and it includes both listed and unlisted. The company will have to pay the tax, not the shareholder. It will be taxable in the hands of the company, not in the hands of the shareholder, the buyback. Okay, remember that point. They may ask under whose head, under in which head, under whose hand the capital gain will be taxable in case of buyback. They will give under in the hands of the shareholder, in the hands of the company, in the both hands. It will not be taxable at all. Like that they will give. You have to tick the correct option. It will be taxed in the hands of the company. Okay. Please mute that side. Okay. Next, index. Whatever the cost of acquisition is there, no, for that we need to do the indexation benefit just to compensate the inflation. What is that? Just to compensate the inflation, we need to do the indexation. I told, no, when I come to indexation, I will tell what is that, what is the meaning of that. Indexation is nothing but to compensate the inflation factor. Okay, you assume that you have purchased one land 10 years back for rupees 6 lakhs. Now, if you want to purchase the same land in this same kind of land in the same area, it may be 40 lakhs. There is a huge difference of 34 lakhs because of inflation. That whatever the land you have purchased, if you are going to sell today, you will have to give the effect of the inflation. What does it mean? Inflation means the cost inflation index. It will be given in the exam. You need not have to remember cost inflation index of the year in which you are transferring the asset divided by cost inflation index of the year in which you became the first owner of the asset. That means when you have purchased the asset, that will be the cost inflation index of that year will be the denominator multiplied by the previous year in which you are transferring the asset. Okay, it will be given in the question. You need not have to scratch your head to remember all these things. All these things for our examination, the cost inflation index will be 317. This will be the multiplication factor. 317 you should multiply divided by any of the inflation, these factors in any of the years. Okay, assume that you have purchased the asset in the year 2013-14. The denominator will be 220. If you have purchased any asset for 10 lakhs, and you are transferring in the year 21-22, that means 10 lakhs into 317 divided by 220 you have to do to get the index cost of acquisition. Okay. Now I will tell you how to calculate capital gain. Calculation of long-term capital gain. Okay, we call it as LTCG. We call it as LTCG. LTCG means long-term capital gain. Please note somewhere, indexation benefit will applicable only to long-term capital gain. It is not for short-term. Only for long-term capital asset, indexation benefit will be applicable. Please write down. Please write down. Indexation benefit will be applicable only to long-term capital assets. Okay, I think few things they have given. If they haven't given, I will tell you all those things. Okay, second one you write. First one, what you have written? First one, what you have written?
Indexation benefit only applicable to long-term capital gain.
Long-term capital asset. That means any transfer of long-term capital asset, the gain arising from that will be treated as long-term capital gain. Okay, only to the long-term capital asset, the indexation benefit will be applicable. How to identify whether it is a long-term and short-term? How to identify the asset is a long-term or short-term?
More than 12 months, less than or equal to 12 months, more than 24, less than or equal to 24.
Which are all the assets falls under more than 24 months category?
Unlisted shares, land.
Unlisted shares and immovable property. Remember all these things. If you default in recognizing or identifying the asset as long-term and short-term, entire problem gone. Though it is 1 mark, entire problem goes for a task. You will not get even a 0.1 marks also. Okay, you need to be very careful in identifying. Next, any asset purchased, please write down. Any asset purchased prior to 1/4/2001, prior to 1/4/2001, prior to 1/4/2001, the assessee, the assessee the assessee can adopt adopt the fair market value of that asset, can adopt the fair market value of that asset as on 1/4/2001, fair market value of that asset as on 1/4/2001, if such fair market value FMV, if such FMV is more than the cost of acquisition, is more than the cost of acquisition, is more than the cost of acquisition. Okay. Huh. What is the meaning of that? Can anyone explain me? With the example. With example. Okay. Please listen. You have acquired an asset. For our easy understanding, I will always take the asset being maybe land or building. Okay. If you have acquired a land on 1/12/98, okay, paying rupees 20 lakhs. On in the previous year 21/22, you wanted to sell that land. Okay, for some consideration. I will not talk about the consideration. I will only talk about the cost of acquisition, how to take it. Okay. Since you have acquired in the year 98 and you are selling in the year 2021/22, obviously it will be long term. Okay. Then at the option of the assessee, if the fair market value as on 1/4/2001 is more than the cost of acquisition of rupees 10 lakhs, whatever you have paid on the acquisition, assume that the fair market value as on 1/4/2001 is 13 lakhs. And the cost of acquisition you have paid on the date of acquisition is 10 lakhs. FMV as on 1/4/21 is the 13 lakhs. Then you can take 13 lakhs as your cost of acquisition. For that, you should do the indexation. Understanding?
Sir, here you're telling the purchase price of the asset was 10 lakh rupees. When
Yes.
we sold the asset, at that time the price was 13 lakh rupees, which was the
No. No. Please understand it properly. Once again, I will tell you. You have purchased the asset in the year 97/98. I will not put the date. In the year 97/98, the asset you purchase, you pay 10 lakhs for purchasing. Okay. You want to sell the same asset in the year 2021/22 for X number, X consideration.
Okay.
I am not at all talking about the consideration. Okay. Now you have to deduct the cost of acquisition. Cost of acquisition. Since this being the long term, Why long term? 97, 98 to 21, 22 is more than 24 months. It is the long term. You will get the indexation. To get the indexation, you need to have the cost of acquisition. That cost of acquisition at the option. Normally, the cost of acquisition, if you have the higher cost, you will get the lower capital gain. Hence, you will pay low tax normally. Okay. The cost of acquisition will be whatever the purchase price you have paid at the time of acquisition or the fair market value as on 1/4/2001. You should compare those two. Whichever is higher, you should take that one as cost of acquisition. For that, you need to do the indexation. Okay.
Yes, sir.
I am not at all talking about the sale consideration.
Okay, sir. Got it, sir.
Okay. Please remember the question will come on these things. Okay. Next. The cost of improvement is also the same thing. Whatever the improvement you make to the asset. What is that? Whatever the improvement you make to the asset. Those improvement is also be treated as equal to cost. Hence, you can deduct the same thing while calculating capital gain. You can deduct the cost as well as cost of improvement. Improvement is what? Extension of the asset. Extension of the asset in the sense, you have a building. I'm giving the example. You have a building. You have building ground floor and first floor. If you construct any one room or one floor above that, that is an improvement. Okay, while selling, you will sell entire unit, all 2, 3 floors, ground floor, first floor, second floor, you will sell. Okay, that is called as improvement. Whatever the improvement you make to the existing asset. If it is long-term improvement, you will get the indexation. If it is short-term improvement, you will not get the indexation. See, indexation will applicable only to the long-term capital assets. Long-term capital assets. Am I telling anything about only to land and building?
No, all the other long-term assets.
All long-term assets, including shares, including anything, whatever it is, only to long term, not to the short term. Okay. Second point on improvement. Any improvement made before 1/4/2001, you need to ignore. You should not consider. What is that? Any improvement made prior to 1st April 2001, you should not consider that. Only the improvement made after 1/4/2001 only you should consider for your capital gain calculation. Second thing. Third thing, please note somewhere, very, 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 very important. Before that, please answer me. If company issues bonus shares, what is that bonus shares means?
For every one share that
Not every one shares. It could be any ratio, any proportion. Bonus shares means what?
Instead of dividend, they give in the worth
They
of
gave shares. Okay. Will they receive any amount from you?
no.
But you will get the shares. That means the bonus shares cost will be 0. Yes or no?
Yes, sir.
Will the company charge anything for the bonus shares if they issue bonus shares to you, to the
No.
you
No.
means to the shareholders? No. Hence the cost will be zero. Only in one case. Only in one case. Remember that one and please note this. If any bonus shares issued prior to 1/4/2001, you can have the option of adopting the fair market value as on 1/4/2001 for the bonus shares also. What is the mean? What does it mean? If you get the bonus shares in some years before 1/4/2001, assume that in 99 2000 you will get the bonus shares. As on 1/4/2001, whatever the fair market value per share, fair market value is there, you can have that fair market value for your bonus shares also. After 1/4/2001, any bonus shares you have received, the cost of acquisition of those bonus shares will always be zero. Okay, you guys need to read all these things. It will be given somewhere. You guys need to read whatever I have told. You need to link that. Okay. See, they are given 1st April 2001. The fair market value you can adopt. Okay. See, cost of acquisition. How to calculate cost of acquisition? For self-generated asset and goodwill, the cost of acquisition will always be nil. See here, bonus shares allotted prior to 1/4/2001. What is the cost of acquisition? Fair market value as on 1/4/2001. Bonus shares allotted after 1/4/2001, cost of acquisition will always be nil.
So how does this make a difference in both the scenario? Can you please explain this?
I cannot explain all these things
No,
because it is irrelevant for the examination. Okay.
Sure. Sorry. I'll check it out.
See these things. Please solve the problems. Okay. Next, cost of improvement. I told cost of improvement. Cost of improvement prior to 1st April 2001 shall be taken to be nil. Okay. Any improvement made prior to 1/4/2001 to any asset, that improvement will be taken as nil. Any improvement made after 1/4/2001 will be whatever the actual cost you have incurred for that improvement, that will be considered as the cost of improvement. You can deduct the same. If it is short term, whatever the cost you incur, you can claim it as deduction. If it is the long term in nature, the improvement is long term in nature, then you will get the indexation also for that. Okay. We solve this problem so that you guys will get to know what is improvement and all. Okay, you guys will get to know. Illustration 3. Illustration 3. Okay. M and Sons HUF had purchased a land for rupees 1,50,000 in the year 2002-3. 2002-3 means, is it prior 1/4/2001 or after 1/4/2001?
Post. After.
After 1/4/2001. Okay. What is the cost they are paying? 1,50,000. Okay. I think they have given the partition and other things took place and the copy gets the plot for rupees 2 lakhs. Incurs 2 lakh 50. Okay. Okay. Next, in the year 2006-7, a partition took place and the co-parcener means member of the HUF is called as co-parcener who has the right over the property in the HUF. Okay. Okay. B gets co-parcener Mr. B gets this plot valued at rupees 2 lakhs. Okay. In the year 2007-8, he incurs expenses means it is a improvement. How much he has incurred? 2,50,000. In which year he is incurring? 2007-8. On the plot towards fencing. Fencing is also an improvement towards fencing of the plot of land. Then after doing that one, he sells the plot for rupees 15 lakhs in the year 2021-22. That is our previous year. In the year 21-22, he has sold. You are required to compute the capital gain for the year 2022-23. You need to calculate the capital gain. Shall we calculate?
Yes, sir.
Okay. Please write down. Please write. Huh. See, before you start, there are certain special cases where it indicates or it specifies what is the cost to be taken. Okay. What is that? In certain cases, they have specified what is the cost to be adopted. Okay. You see here. Earlier, this plot of land was with HUF. On partition, Mr. B gets. Earlier, assume that earlier it was your father's property. After that, it came to you. It transferred to you. You will not pay anything. Then, should I take cost as zero or how? The question comes. Always, in case of gift, inherent, will, or in the partition, the cost to the previous owner will become the cost to the current owner. What is that? Cost to the previous owner will be the cost to the current owner. Have you guys written?
Yes, sir.
Okay. Huh. Now, in this case, what is the cost to the previous owner?
1,50,000.
That you need to be taken as your cost. For that cost, you need to index. Okay. In this problem, they have not given the indexation. Ideally, they will give. Okay. In examination, they will give. Okay. Please write. Please write. Sale heading you write. Computation of computation of capital gain. Computation of capital gain of Mr. B for the previous year or for the assessment year, whatever you can tell, for the assessment year 22-23. For the assessment year 22-23. For the assessment year 22-23. Okay. Next line. Have 3 columns. First column particulars, bigger column. 2 amount columns. On the right hand corner, have 2 amount columns. Okay, in particulars column, sale consideration. Sale consideration. How much money he is selling?
15 lakh.
Right on the last column.
So,
Yeah,
can you please repeat once?
which one?
After particulars, what do we have to do?
2 more columns for the amount.
Uh-huh.
Have it on the right hand corner. You can write at least 6 to 7 digits of 2 columns.
Okay.
Okay. After that, please write in the particulars column sale consideration. Sale consideration. Last column, you write 15 lakhs. In the last column, you write 15 lakhs.
Yes, sir.
Okay, 15 lakhs. Next, minus. Now you have to ensure, do we need to index cost or simple plain cost? Is it the long term or short term?
It's long-term improvement.
Long term. Then you write less index cost of acquisition. Less index cost of acquisition. Index cost of acquisition. Okay. Below that, within brackets you write. Below that, within brackets you write. Below that, within brackets you write. I am going above to see the inflation index. Okay. I want this one. That's why I am coming here.
$129. 78.
Which year?
78.
No, I think he has. Which year he has?
Improvement, right, sir?
Not improvement.
Okay.
2002, 2003. 2002, 2003. It should take.
1 second. 2000.
Purchased in the year of the 2002 and 2003.
Not that one. 1 second. See, here there are two dates. One is when the asset held by the HUF for the first time, 2002-3. The partition took place on 2006-7. Okay. Listen carefully. Listen carefully. Whenever we are taking the cost to the previous owner, what is that? Whenever we are taking cost to the previous owner as cost of acquisition, as cost of acquisition, okay, as cost of acquisition for us, then we need to consider the period of holding of the asset for the first time in which the previous owner is also hold. What does it mean? When the previous owner holds that asset for the first time, that year you need to consider the cost, the period of holding from that year, not from the year in which you became the owner. That means in this case, you need to consider the index cost for this from this year, 2002-3. What is that index cost? 2002-3.
105.
105. Okay. Now you write 1,50,000. 1,50,000 into 317, this one multiplied by 317 divided by 105. What is the value you got? Write it in the second column, inner column. What is the amount you got?
452,857.
Write it in the inner column. Inner column. Okay. Next, cost of index cost of improvement. Indexed cost of improvement. How much he has made the improvement? 2,50,000. 2,50,000 below the line, 2,50,000 multiplied by 317. Only the denominator will change, divided by when he has done the improvement 2007-8. What is the index 2007-8?
129.
129. 2007-8 129 divided by 129. How much you got? Put that value below the first one you have written of 452. Below that one you write. Add those two. Put it in the next column. Deduct from 15 lakhs. Whatever the difference you get, either it will be long-term capital gain or long-term capital loss.
6,14,341.
Okay. Please put it in the second column below that. You add these two. Put it in the next column. Deduct from 15 lakhs. Whatever you get, it will be long-term capital gain or long-term capital loss. If the minus comes, it will be loss. If it is positive, it will be
Yes, sir. Gain.
It's a capital gain, sir.
How much gain you got?
4,32,802.
Is that correct?
Yes, sir.
Got it, sir.
Okay.
Yes.
This is how you guys need to calculate. Let me be very frank. Capital gain is one of the most easiest chapter, provided if you understand it correctly. Otherwise, it becomes very difficult thing. Okay. See, they have given the what is to be taken as cost in specified mode. In this, total or partial partition of HUF. Okay. In that, whatever they have told, cost to the previous owner. What is the cost to the previous owner? That will be the cost to you. Okay. Everything they have given. You guys need to dig that one. Okay. See here, indexation benefits from which year you have to consider. Whether do you need to consider from the year in which you became the owner, or even if it is for the previous owner also you need to consider. Always you need to consider from where you are taking the cost. If you are taking the cost from the previous owner, you have to get the indexation from that year. If you are taking the cost of your own purchase, then you have to take the indexation from the year in which you became the owner. I mean to say, when you purchase the asset. Okay. There is one excellent case law is there, Manjula Shah. I think somewhere it will be there, indexation benefit. Bombay Court was, yeah. See, Manjula Shah case. This is the decided case. We all take the precedence from this case, and we always take the cost and the indexation of the previous year, previous owner's year in which he purchased the asset. Even in case of gift also, inheritance, will, always we consider that one. Okay. Please go through all these things. I cannot go line by line. Few are important, few are not important. You need to understand which is important, which is not important. Okay. Next, capital gain for depreciable asset. What is that? Capital gain for depreciable asset. What are those depreciable asset means? How many blocks we saw in business head? How many blocks?
4.
What are those?
Salary.
Or
What?
Depreciation. Plant
Oh,
and machinery.
plant and machinery,
Plant and machinery.
furniture, building, and intangible. Those 4. Okay. If there also we calculated, if you remember those things, if your cost of purchase and the opening balance falls short of the selling price, then it is gain. For above more than the selling price, it becomes loss. Understood? See, opening WDV. Opening WDV. Assume that opening WDV is 2 lakhs. I will take one of the example. Okay. Addition 3 lakhs. Total comes to 5 lakhs. Okay. Now you will sell the asset. You sold it for 6 lakhs. Then what is the difference? The opening balance and addition comes to 5 lakhs. You sold that one for 6 lakhs. What is the balance? Difference is what?
1 lakh, which is a loss.
Profit, right?
This is profit 1 lakh. Okay. The same example. The same example. If it is 4 lakhs. 4 lakhs. This 1 lakh is loss. Okay. Whatever the profit or loss you get of depreciable asset, it will always be short term gain or loss. The gain or loss on sale of depreciable asset will always be short term, not the long term. What is that? The gain or loss arising on the sale of depreciable asset will always be short term or long term. Short term gain or short term loss. It will never be long term. Section 50C. That one. Section 50. 50C is guidance value. Okay. See, somewhere it will be given. I will show it to you also. See here. Short-term capital asset. See here, short-term capital gain. It will always be short-term, not the long-term. Okay. You will get the question on this. The gain or loss arising from transfer of a capital asset which is depreciable. You get the option short-term capital gain or loss, long-term capital gain, long-term capital loss. None of the above like that they will give. Okay. You need to tick the short-term capital gain or loss. Next, mark this one as important. Slump sale, section 50B. slump sale means what? If your company having 3 units, unit A, B, C, one of the unit if you sell, that is called as slump sale. What is that? One of the unit you sell. Unit as a whole, if you sell, not selling the individual assets. You will sell the unit as a whole. That is called as slump sale. Okay. How to calculate the capital gain from the slump sale? The calculation of capital gain in case of some slump sale will be sale consideration or fair market value of that unit minus net worth. What is that? Please write down. Don't simply sit and listen. Please write down. Calculation of capital gain in case of slump sale. Next line. Sale consideration or fair market value minus net worth.
Sir, a bit slower.
Innu slow na.
Sir, please repeat.
The calculation of capital gains in respect of slump sale. Next line. Sale consideration or fair market value. Next line, minus net worth. The difference will be either short-term capital gain or long-term capital gain, or short-term capital loss or long-term capital loss. Okay, either short-term or long-term, gain or loss. How to identify short-term or long-term? If that unit is more than 36 months old, then it is long-term. If that unit is less than 36 months, it is short-term. Unit, not the individual assets. Okay. It is given now. See, held for more than 36 months. Long term. Less than 36 months. Short term. Okay, next line. Net worth is equal to. Net worth is equal to. Assets minus outside liabilities. Assets minus outside liabilities. Okay. Next line. Assets for net worth is equal to. 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 Depreciable asset. Depreciable asset. Hyphen. Hyphen. Consider the WDV as per IT Act. Depreciable asset. Consider the WDV as per IT Act. What are the depreciable assets? Building, plant and machinery, furniture, those things you need to consider as per WDV. Non-depreciable asset. Non-depreciable asset. What is that non-depreciable asset? Non-depreciable asset, what?
Land, sir.
Land. Only land. For that, the value to be considered is the book value. Value to be considered is the, sorry, not the book value, cost. Cost. Within brackets you write, exclude revaluation. Exclude revaluation. Okay. Any other asset. Third one. First one depreciable asset. Second one non-depreciable asset. Third one any other asset. Book value. Any other asset. Book value. Any other asset means stock, debtors, bills receivable, loans and advances. All will be there. No, that one you need to consider the book value. Whatever it is shown in the balance sheet, you need to consider. It will be given clearly. You need not have to scratch your head. Only scratch your head only for the purpose of non-depreciable and depreciable. For that you need to have. They will give WDV, book value of the depreciable asset. They will give this much. Depreciable assets, WDV will also be given. You need to consider the correct one.
Sir,
Yeah.
for depreciable asset, what should be considered?
WDV of the asset. WDV, depreciable.
For any other asset?
Any other asset, book value.
Okay, sir.
Okay. While taking liabilities, whatever the liabilities, outside liabilities, you need to deduct that one. Okay, only they will give liability 1 or 2. Okay, you need to deduct. The question will not be so big. The big questions will not come. 4 to 5 lines question, maximum 6 or 7 line questions will come. That's it. You will not get 20 lines questions. You will not get. Don't worry. But they will give the items. Items in the sense the like this: debtors, machinery, land. In that revaluation reserve, creditors, bank loan. They will give. You need to calculate net worth based on the whatever the explanation you guys have written now. Okay, that is 50B slum sale. 50C. 50C. What is that? Capital gain in respect of immovable property. Capital gain in respect of immovable property. Okay. Okay. You have one land. Listen carefully. You have one land. Okay. You are selling that land for 1.2 crores. You are selling the land for 1.2 crores. This is the agreed value. This is the agreed value. You are selling at 1.2 crores. Agreed value. Okay. Normally, whatever you specify in the agreement, will you receive the same amount or more amount or the lesser amount? When you are selling any land or when you want to purchase any land, you enter into an agreement, right?
Yes, sir.
Okay. Huh. If you enter into an agreement, okay, the land whatever you are going to sell or purchase from your end, selling means from the other party's end, you have to see. Okay, you will enter into an agreement stating that you will pay some amount, some value, whatever the value they mention in the agreement. Is that amount you will pay or receive, or even more than that you will receive or pay?
So whatever the amount it is agreed in the agreement, that much amount we will pay.
Who will pay?
He will receive the more.
More, always. That is the black money. Whatever they have mentioned in the agreement is the white money. Whatever it is not mentioned and you receive, it will be the black money. You will receive more. Okay. Assume that the value where it is going to be 2 crores. The property which is going to sell at 2 crores, but you have entered into an agreement for 1.2 crores. Okay. Stamp duty value. Stamp duty value means what?
Registration charges for the
Registration, stamp duty you will have to take. Stamp duty value is 1.3 crores. The stamp duty comes to 1.3 crores. Now the question arises, which value need to be considered? Is it the agreement value or is it the stamp duty value you need to consider? As sale consideration. Okay. For the seller angle you need to see now. As the sale consideration, how much I need to consider? Is it 1.3 crores or 1.2 crores? Okay, for that section 50C gives some guidelines that you need to adopt. What is that guidelines? We will see. Okay, I will straight away go to the point. I will not explain all these things. See here. For the purpose of payment of stamp duty in respect of such transfer, stamp duty, I am referring to stamp duty, the value so adopted or assessed shall be the full value of consideration. What is that? The stamp duty value will be considered as full value of consideration, and capital gain shall be computed on such consideration. Okay, stamp duty value will be considered as full value of consideration, provided where the stamp duty does not exceed 110% of the consideration received, provided the value does not exceed 110% of the consideration received or accruing as a result of such transfer, the consideration so received or accruing as a result of the transfer shall, for the purpose of computing profits and gains from transfer of such asset, be deemed to be the full value of consideration. Do not understood. Okay, now you need to calculate whatever the consideration you are calculating. Take that consideration. I will write here so that I can calculate it here. 1.2 crores. Okay, now you need to calculate 110% of this consideration. 110% is nothing but 10% more than this. 10% more than this. Okay. It comes to 1.32. Understood? What you
Yes.
need to do first? It is applicable only to immovable properties, land and building. It is applicable only to immovable property, not to any other asset. Okay. If the 110% of consideration, if 110% of consideration is more than the stamp duty, listen carefully. If 110% of the consideration is more than the stamp duty, then the actual consideration or the agreement value to be taken as sale consideration. What is that? If the stamp duty value is lesser than the 110% of the consideration, then the agreement value will be taken as sale consideration. Assume that the stamp duty value is more than the 110%. Then you need to consider stamp duty value. There are two scenarios. Are you guys understanding? If you do not interact, I will assume that you guys are understanding. I will go. I mean to say I will proceed. Okay. I will tell you once again. Please listen carefully. If your consideration is 1.2 crores, you need consideration means agreement value is 1.2 crores. You need to calculate 110% of that. That means add 10% to this agreement value. This is the after adding 10%, it comes to 1.32. Compare this with the stamp duty value. If the stamp duty value is lesser than this 110%, then the sale consideration will be agreement value, that is 1.2 crores. Okay, this is the first scenario. If the stamp duty value is more than the 110% of the agreement value, what is that? If the stamp duty value is more than the 110% of the consideration agreement value, then you need to consider stamp duty value. That means you need to adopt stamp duty value as your full value of consideration. Now, please understand the logic. Why the people will receive the lesser amount than the market value?
To
Why
pay
the
less tax.
less tax? Why,
Yes.
why the government has prescribed these rules? To curb the malfunction. That's why they have. If it is less than the market value, I mean to say the stamp duty value, less than the stamp duty value, then you should take stamp duty value as your sale value of consideration. If it is more, then actual consideration can be taken, actual agreement value can be taken as your sale value of consideration, full value of consideration. Okay. You will get question on this specifically 50C. 50D, it's only how to calculate the values and other things they will give. You see, we will do this one. Illustration 7. X entered into an agreement for the sale of his house. Is it movable or immovable?
Immovable.
Immovable. When he has agreed for the sale, whenever there is 19, you make it as 21. 1 second, could not. Okay. Make it as 20 or 19 is also okay because there is another line is there. Okay, first I will read out and I will make the correction if it is necessary. For a total consideration of how much is the consideration? 90 lakhs. For this 90 lakhs, you need to compare. First thing. Okay. Next, Y paid an amount. See, X entered into an agreement for sale. Agreement for sale. X is entering. Now tell me, X is the seller or buyer?
Seller.
Seller. Okay. Who is buyer? Y.
Why?
Y paid an amount of rupees 20 lakhs by account pay check to X on the date of agreement, and the balance was to be paid at the time of registration of the deed. Okay. First Y has paid the advance of rupees 20 lakhs, token advance, and balance 70 lakhs will be paid at the time of registration. This was the agreement. However, the conveyance deed could not be executed till 1st September 2020. 1st September 2020, the deed did not happen. I mean to say the sale did not took place till this date. The stamp valuation authority determined the value of property on the date of registration of conveyance deed at rupees 120 lakhs. Okay, who is doing this one? Stamp duty value. On which date they are taking? On the date of, see, this date important, on the date of registration of the conveyance deed. Registration of the conveyance deed means what? Actual registration date. They are assuming it to be 120 lakhs. And the value determined by the stamp valuation authority on the date of agreement date. Agreement date, it is 100 lakhs. They are determining, there are two scenarios. One is on the date of registration, the value of the property will be considered as 120 lakh as per stamp duty valuation. On the date of agreement, they are considering the full value of consideration as 100 lakhs. Which one to be taken is the question. Okay. Understanding, you guys?
Yes.
Yes, sir.
Listen now carefully. This is very, very important. You will get the question. The same logic applicable to business head also. Section 43 CA. Whenever you want to go there, and you go there. 43 CA, I believe. Okay. See, if any advance money, write it down somewhere. If any advance money is received through specified modes. Specified modes means what? Check, account pay check, bank draft, like that. If in the specified modes, then the stamp duty value on the date of agreement to be taken as full value of consideration. What is that? Stamp duty value will be adopted as full value of consideration. Once you adopt that one, this same thing. Same thing, 10% you need to calculate after that. Compare that with the stamp duty value. Then arrive at the full value of consideration. Like that.
Sir, so advance money received through any specified modes, then stamp duty value is adopted as full value.
On the date of agreement. On the date of agreement. Agreement date, not the registration date.
Okay.
See, in your locality there will be a tea stall will be there, no? Normally the brokers will come and sit there and drink tea. While drinking tea only they will decide the terms. The agreement will take place on the tea stall, but the actual registration will take at the sub-registrar office. Two different places. The gap will be minimum 3 to 6 months gap will be there depending on the transaction. Okay. Stamp duty value on the date of agreement to be considered as value of stamp duty. Once you consider which one to be adopted, then the same 110% you need to consider with the consideration, whichever is 110% is less than the stamp duty valuation, then the actual consideration, the agreement as per agreement to be considered as full value of consideration. If the stamp duty value is more than that 110%, then the stamp duty value will be considered as the full value of consideration. This one, advance money forfeited, advance money received forfeited. What is that meaning of this word or the sentence? Advance money received forfeited.
So is it like when giving the rent, we give certain amount of advance?
No, not the rent. Don't bring the rent into capital gains.
Okay.
See, take an example. We both will enter into a contract in the sense agreement. I will purchase the property or asset. Okay, it is applicable to all. Okay, we enter into an agreement, oral agreement first time, that I will tell you that I will purchase this one. What is the amount to be paid? You guys will tell, sir, it is 15 lakhs. I agree that, yes, I will buy for 15 lakhs. What I will do, after 2 or 3 days, I will come and give you 1 lakh rupees as advance. And I will tell you that, please, we make an agreement. I have paid 1 lakhs. The balance 14 lakhs I will be paid at the time of registration. What the previous question is there? Extension of that. We both will agree for that. Okay, you also agree. You can pay 14 lakhs at the time of registration. I don't know, somehow I couldn't able to arrange the fund. I will tell, I cannot buy this one. You people will return only 50,000 to me. I am more fortunate that you will return at least 50,000, and you guys will forfeit the balance 50,000. What is that? Whatever the advance money I had given, you may pay some part or full, or you will not pay any part. There could be 3 scenarios, right? You will retain entire 1 lakh, you can return entire 1 lakh, or you can pay me little bit, any sum. Okay, whatever the amount you retain, please listen here. Up to this, it is the story. Now the provision I am coming. Whatever the amount you guys retain of the advance amount, if that advance amount is received prior to 1st April 2014, which date?
1st April
1st
2014.
April 2014. Then you need to deduct that advance amount retained from your cost of acquisition. What is the provision? Whatever the advance amount retained in the sense forfeited, which has been received prior to 1st April 2014, then the amount forfeited has to be deducted from the cost of acquisition. If any amount of advance retained after 1st April 2014, whatever the amount retained will be treated as income from other sources. It should not be deducted from the cost of acquisition. Understood?
Second part, can you repeat, sir?
Any advance money forfeited after 1/4/2014, that amount will be treated as income from other sources and it will not get deducted from the cost of acquisition.
Okay, sir. Understood.
See, I tell you, there are so many things. In spite of that, I am skipping many things without your knowledge. I mean to say, in betweens, I mean to say the many provisions I am skipping. Please go through all those things. Whatever I feel important, I am telling. Because huge syllabus, I cannot complete. I will guarantee that. I cannot complete. Even if I get 150 hours also, I cannot complete. Still, as far as possible, I am going to little things in detail. Okay. See here. However, any such sum money forfeited before 1st April 2014 will be deducted from cost of acquisition. What is this? Before 1st April. Okay. It will be deducted from cost of acquisition. Okay. If such sum is forfeited on or after 1st April 2014, it will be taxed under the head income from other sources. There are two parts. What you need to keep it in mind in this? What is the important thing you need to keep it in this provision? Which one to be keep it in mind?
Before 1/4/2014.
The date is very, very important. Okay.
Yes,
This
sir.
is about section 51. I may come to exemption. 1 second. 112A, 111A, I haven't seen whether it is below. Okay. Because that's the most important part of this entire capital gain.
Sir, 112 went up.
No, went down. It is in the down.
Okay.
Okay. Exemption from capital gain. Exemption from capital gain in the sense, whatever the capital gain you get. How to get capital gain? Sale consideration minus cost of acquisition or index cost of acquisition, cost of improvement or index cost of improvement. If you deduct that one, whatever you get, it will be either short term or long term gain. If you get the gain, then you can have the exemption provided if you satisfy some of the conditions prescribed under the respective sections. Okay, I will deal only with 3 sections. Section 1 is 54, section 2 is 54 EC, section 3 is 54 F. The remaining sections you guys need to go back and read, because I cannot what do you call, I cannot teach all the sections because it is highly impossible for me to go through the entire section. Those sections, whatever I am leaving, are not that important. That is why I am leaving. 54 is important because there is an amendment. 54 easy. Normally you will get the question on that. Hence I am doing that one. 54F is related to 54 and 54 easy. That is why I am doing 54F. Okay. First section 54. Eligible assessee, individual and HUF. Who are eligible for this exemption? Only the individual and HUF. For what they get the exemption? They get the exemption from the capital gain when they get the gain from the transfer of residential property. Underline this. This is the first thing in the 54. If you have any residential property, if you transfer that residential property, on transferring, if you get gain, then you can have the option of getting the exemption from this section 54. What is the quantum of exemption? How much exemption I will get? For what I will get the exemption? Okay. You will get the exemption if you invest in the sense, if you purchase any residential property, if you purchase any residential property prior to 1 year from the date of transfer, ಒಂದು ವರ್ಷಕ್ಕಿಂತ ಮುಂಚೆ ನೀವೇನಾದ್ರೂ ಹೌಸ್ ಪ್ರಾಪರ್ಟಿ ಪರ್ಚೇಸ್ ಮಾಡಿದ್ರೆ 1 year will be considered the date prior to that date, 1 year. If you have purchased any property, or if you are going to purchase any property after 2 years from the date of transfer. You guys are not, I don't think you guys are catching.
No, sir. Date of transfer.
1 second. Tell me any date in the year 2021-22. Any date.
August 1st.
1st August. Is your birthday?
No, sir.
Okay. August 1st. One year before from this date, 1st August 21. 1 year before from this date means which day? 1 year before.
August
August
20.
2020.
1st August 20. Okay. You can purchase the house. You can invest in house. You can invest in house. Otherwise, within 2 years from this date, that is 1st August 23. After this, within 2 years, you can purchase the residential house. If you utilize entire capital gain, assume that I am just writing sale consideration. Sale consideration is 1 crore. Sale consideration is 1 crore. Okay. Index cost. Index cost comes to around 0.5 lakhs. Okay. The difference 50 lakhs is there, no? this 50 lakhs, if you utilize the entire 50 lakhs for the purchase of house prior 1 year, before 1 year, or after 2 years from the date of sale, then this entire capital gain will get exempted. Assume that your new house cost is 40 lakhs. Then you will get the exemption 40 lakhs, 10 lakhs becomes taxable. If new house cost is 60 lakhs, you will not get a refund. It will be restricted to 50 lakhs only. Entire capital gain will be exempted. Okay, whatever we are studying now is related to capital gain. This gain will get exempted if you invest in specified assets. Okay, or if you construct any residential property within 3 years from the date of transfer, then the capital gain exemption will be applicable. The same logic, if the cost of the construction becomes less than 50 lakhs, only to that extent will be exempted. If it is more than 50 lakhs, the entire capital gain will get exempted. Understood? Okay. Now I will come to amendment. Okay. If this is the amendment. Okay. Not this one. If your capital gain, assume that now this is 2 crores, your capital gain. If your capital gain does not exceed 2 crores, please listen carefully. This is the amendment. The chances of getting this question is high. Okay. If your capital gain does not exceed 2 crores, then you have the privilege of getting the exemption of 2 house properties. In the earlier one, only 1 house property, you will get the exemption for only 1 house property. If your capital gain is less than or equal to 2 crores, then if you invest entire capital gain, which is equal to or less than 2 crores in the new house, 1 house and the another house, 2 houses, the total of those 2 cost, if it does not exceed 2 crores, entire 2 crores becomes exempted. This option is available to the assessee only once in his lifetime. He cannot have this opportunity again in any of the years. Only once in his lifetime he can exercise this option. Understood? What is the catch here? The capital gain should be equal to or less than 2 crores. Then the assessee can have the exemption of 2 houses. The cost of the 2 houses should not exceed 2 crores. That means entire capital gain will be exempted. Even if it exceeds 2 crores also, 2 crores will get exempted. Okay. This is the logic. This is what? This is 54. I will quickly tell 54F. 54F. Here it is what needs to be transferred? Residential property here. In 54F, any long-term capital gain arising on transfer of long-term capital asset other than residential house property should be there. Here, exclusively residential house property, no other capital asset. In 54F, residential house property, excluding that, all other long-term capital gains is applicable to this 54F. In this 54F, if you invest the net consideration in the sense what? Sale consideration minus expenses. This is net consideration. If you invest the entire net consideration, you will get the exemption from the capital gain, the entire capital gain. Are you guys understanding? If index cost of acquisition comes to 2 crores, then capital gain will be 2.3 minus 2, 30 lakhs. This is the LTCG. Okay. Listen carefully. If your net consideration means sale consideration minus expenses is the net consideration. If you invest the entire net consideration in the capital gain, in the asset to buy the residential property, you should not transfer the residential property, but you should acquire only the residential property in 54F. Then the entire capital gain, whatever is there, that will be get exempted, 30 lakhs. Or if it is say 1 crore, 1.3 crores will get exempted. If you invest entire net consideration, you are not going to invest the net consideration, entire net consideration, then the proportionate capital gain will get exempted. Assume that you will purchase the house for 2 crores. Then how much it will get exempted? 2 crores. See, 1.3 crores for 2.3, then how much is for 1.3? Like that you need to calculate proportionate. If you invest 2.3, you will get exemption of 1.3. If you invest 2 crores, how much you will get exempted? That is the proportionate. Only proportionate exemption from this you will get exempted. Okay. How? 1.3 divided by 2.3 into 2. How much it will be? 1.13 it will get exempted. The balance how much? Balance 17 lakhs will get taxed. Like that, 54F. Okay. Last one, 54EC. If any capital gain, this one, if any capital gain arises, if you invest in specified bonds, if you invest the capital gain in the specified bonds within 6 months from the date of transfer, if the date of transfer is this one, assume, if you invest in specified bonds within 6 months from this date, what is the 6 months from this date? August means August, September, October, November, December, January. Within 31st January, if you invest in specified bonds up to rupees 50 lakhs, you will get the exemption. How much? Up to rupees 50 lakhs, you will get the exemption. The balance becomes taxable. What is the condition? Within 6 months from the date of transfer, you need to invest. Then you will get the exemption of 50 lakhs. Sir, can I apply all these three? You can apply. You can get the exemption of 2 or more sections also. Okay, this is all about exemption. Tomorrow I will do 111, 111A and 112. See, whatever I have told, it will be there. You guys have to just see the specified bonds. You see here I told now 50 lakhs where it is 5 years. See, 50 lakhs exemption. Okay, within which month? Within 6 months. Within 6 months you need to invest. They have given the answer also. See, 6 months. Within 6 months from the date of transfer, you need to invest in bonds. What are the bonds? Bond notified bonds of NHIL, RECL, like that. The exemption 50 lakhs. See, everything is there. You just need to see. Okay. Tomorrow, please remind me this section, important section, page number 318. Okay. See you then. I have a class. Next class, I will have some water. Then I will have to start the next class. Okay. I believe you guys are understanding. Please read, because I am helpless in few situations. I have to complete the many things. I will only take till this month's income tax. From next month, I will go to GST, irrespective of the completion, because GST is also there. I need to complete that one also. Okay. Thank you so much.
Thank you, sir.
Thank you, sir.
Yeah.
Thank you, sir.
Thank you, sir.